This will be probably one of the most classic questions that we receive in technical interviews for investment banks or private equity firms, or even hedge funds or asset management firms as well. Even me, I personally received this question several times, and the topic is always depreciation. And probably one of the reasons why this topic is so famous is because, number one, it's not that simple. It's quite complex, especially if we have tax rates assumed. And number two, you really need a lot of understanding of how the three statements work and affect each other in order to answer this specific question. So this question can allow the interviewer to roughly find out whether the candidate has basic understanding of accountings. So we're going to start as usual from the income statement. See, depreciation has increased by 50. So are we going to increase cost of goods sold, or are we going to increase SG&A? The answer is it can be either. If this $50 is directly related to revenue, we would write it under cost of goods sold. If it's vague or if it's clearly not related to revenue, we write it under SG&A. For now, let's write it under SG&A. So an increase in operating expenses worth 50 would decrease operating profits and earnings before taxes as well. We've assumed a 30% tax rate, so tax would be deducted by 50 times 30%, which is 15. And as a net income would be down by 35. According to our formula, the cash flow statement will start from a negative minus 35. And according to our formula, retained earnings is down by $35. So up till here, it's fairly simple. Now we're going to move on to the cash flow statement. So how much cash has been actually inflowed or outflowed? Is that easy to figure out? No, I think it's not that clear. So what we're going to do is we're going to make direct adjustments first. Depreciation is a positive adjustment to cash flow from operations. This you might want to memorize. So usually under cash flow from operations, we see depreciation and amortization under the indirect method. So because depreciation is a non-cash cost, we add it back to the cash flow statement. And as a result, we get a net change in cash worth plus $15. And what does this $15 match? It matches the tax expenses that we have saved because of the depreciation. So even though depreciation is a non-cash cost, in our accounting-based three-statement model, it provides a tax shield effect worth $15, and this is the result of it. Changes in cash will be reflected on the year-end cash balance. So cash is going to be up by 15, and depreciation decreases net PP&E balances. So cash is up by 15, PPE is down by 50, and as a sum, the asset side is down by 35, and also the liabilities and equity side down by 35 as well. To sum up, operating expenses increased by 50, whether it's COGS or SG&A. Pre-tax income falls by 50 and net income by 35, assuming a 30% tax rate. Net income is down by 35, but depreciation expenses are added back, so cash worth 15 seems to be saved. Cash is up by 15, and depreciation results in a $50 decrease in net PPE. Remember that in the balance sheet we always record PPE or intangible assets on a net basis. And lastly, 35 decrease in net retained earnings from a decrease in net income. As a result, balances the balance sheet. And for your information, if you receive questions on amortization of any type, usually it's completely the same, just we want to change depreciation into amortization, and instead of PPE, it's going to affect intangible assets. That's the only change, and the others are going to be exactly the same.